Insurance to protect assets. While life insurance and disability insurance protect dependents and income, respectively, they don't always protect an individual's assets, such as investments, RRSPs, or real estate, from being depleted by a long-term illness. Critical illness, CI, insurance and long-term care, LTC, insurance are designed to provide living benefits to help protect these assets from the high costs of prolonged health-related expenses. Critical illness, CI, insurance. CI insurance provides a tax-free, lump sum payment if the insured suffers a life-threatening or life-altering condition covered by the policy. The money can be used for anything the insured chooses. Who needs it? With improvements in emergency and medical care, more people are surviving catastrophic health events like heart attacks, strokes, and cancer. For example, 95% of heart attack victims survive their first attack, and 65% of cancer patients survive for at least 5 years. However, these survivors may face significant expenses or lifestyle changes not covered by traditional insurance, such as paying off debts like mortgages or credit cards, pursuing alternative medical treatments, making home renovations to accommodate a physical disability, reducing work hours or changing to a lower stress job, which may decrease income, taking vacations to relieve stress. Policy details. Issue ages, typically issued to applicants between the ages of 18 and 65. Special plans with lower benefits are available for children. Coverage amounts. Face amounts can range from as little as $10,000 to as high as $2 million, but are more commonly between $50,000 and $500,000. The amount is based on factors like age, financial status, and health history. Waiting periods. Qualification period. An exclusionary period, usually 30 days, from the policy's issue date during which no claim for a diagnosed or manifested condition will be covered. This protects the insurer from anti-selection, where people seek coverage because they suspect they are ill. Survival period. A waiting period, often 30 days, between the diagnosis of a covered condition and the payment of benefits. Types of policies. Basic policies often cover the big four: heart attack, stroke, cancer, and coronary bypass surgery. Comprehensive policies can cover 20 or more conditions. Children's policies cover conditions more common in minors, such as muscular dystrophy, type 1 diabetes, and cerebral palsy. Mortgage-linked policies, issued through financial institutions to pay off a mortgage balance if the insured suffers a critical illness. Guaranteed issue, offered without medical underwriting but are typically more expensive and have limited benefits. Riders. Return of premium, ROP returns some or all premiums if the insured dies or the policy expires with no claim filed. Waiver of premium, waives future premiums if the insured becomes totally disabled. Tax treatment. Premiums for individual CI insurance are not tax deductible. However, the benefits received from a claim or an ROP are not considered taxable income. Long-term care, LTC, insurance. LTC insurance is for individuals of any age who can no longer perform daily physical tasks independently due to illness, injury, or aging. It is not disability insurance. It does not replace income. Instead, it provides a daily maximum benefit to cover the costs of professional care services, which can range from in-home care to nursing home facilities. Who needs it? The need for LTC is often associated with the elderly, and with the aging baby boomer population, the percentage of Canadians over 65 is expected to grow significantly. In 2011, 7% of Canadians aged 65 and older lived in care facilities, and this number increased to 30% for those 85 and older. Government funding for long-term care is stressed, and an individual's personal insurance coverage can be part of the solution. LTC insurance is particularly beneficial for minimizing costs. It reduces or eliminates the financial burden of long-term care, which can range from $900 to over $5,000 per month for a nursing care facility. Ensuring quality of care. It allows an individual to seek the level of care they need, not just what they can afford. Maintaining dignity. It gives individuals a feeling of self-control and independence, knowing they don't have to rely on government assistance or their family. Policy details. Types of care covered. LTC insurance covers in-home, assisted living, or nursing facility services for individuals who can't function independently. This includes home care, e.g., nursing care, home help, respite care for family caregivers, assisted living facilities, and nursing home care. Qualification for benefits. An individual typically qualifies for benefits if they are unable to perform 2 or more of the 6 activities of daily living, ADLs. These include dressing, bathing, toileting, transferring, e.g., from bed to chair, eating, maintaining continence. Alternatively, benefits can be triggered by a diagnosis of severe cognitive impairment. Riders. Cost of living adjustment. COLA increases the daily maximum benefit annually, e.g., 2% to 3%, to keep pace with inflation. Return of premium. ROP returns some or all premiums if the insured dies with no claims made. Tax treatment. Premiums paid for LTC insurance are not tax deductible, but may qualify for the federal medical expense tax credit. All benefits received are tax-free to the insured, regardless of whether they are paid directly to a provider or as a reimbursement to the insured.